Thanks for joining us on another For Investors, By Investors South Bay podcast. As always, we are proud to be your all-education real estate investment resource without any kind of sales pitch. If you would like to attend one of our meetings in person, we meet the second Wednesday of the month at The Point in El Segundo. You can RSVP at forinvestorsbyinvestors.com/South Bay. To find more investment resources such as blogs and podcasts from other FIBI groups, go to forinvestorsbyinvestors.com and search our library. Now, on to the podcast.
Thank you guys for coming. We appreciate it. FIBI stands for For Investors by Investors, and it was created by a couple of full-time investors that were tired of getting the sales pitch every time, the boot camps and the book and tape sets and all that kind of stuff, and they wanted a place where people could go, network, and meet other investors and learn without getting that pitch every time at the end of the meeting and things like that. So that's where FIBI was born, and now we're a nonprofit organization. We basically teach financial education and real estate education and have multiple chapters throughout Southern California. We have one in Orange County. We have one in Pasadena. I run the Long Beach one. Dave and I run this one as well. And we've been doing this since, 2012 in this one? So, and I was running Long Beach for 2009 or something like that. So it's actually, it's been one of the best things that have really compounded our relationship bases and our businesses as a whole, just because we can't do this without each other. And this is actually really, really huge. Like, we come up here and learn as well from some great speakers and top people in their fields that know what they're doing. And it's really hugely valuable. So if you guys really want to learn about real estate and get started, or even if you're seasoned and want to learn some new tools for the tool belt, then, feel free to come to our events. And, you can find us on meetup.com at and type in FIBI, or you can go to our website, forinvestorsbyinvestors.com. So that being said, you want to talk about our sponsors real quick, and then and then we'll.
How you guys doing? So if you need more chairs, we have some chairs stacked up behind this wall. Feel free to grab a chair, get comfortable. Thank you guys for coming out tonight. As Matt said, we started this group in 2012. FIBI itself has been around for 10 years. We've got 6 chapters active in Southern California, and I think we're close to almost 28,000 members now throughout Southern California. And I get asked all the time, how do I invest in FIBI? And I'm like, there is no investing in FIBI. We're not. This isn't a club where we're all going to pool our money together. That's not what FIBI's all about. But I will tell you that every real estate investment deal I've ever done, somehow, some way, FIBI's connected to it. I met a resource. I met someone who had a property for sale. I met a lender. So really the power of FIBI, will be in the education tonight. We've got a fantastic panel, 3 really good speakers. For this particular club, we always try to find people, and don't take this the wrong way, that aren't polished speakers. And I say that, not that these guys aren't polished. Trust me. For your benefit, they're not here to put you into their books and tapes. This isn't going to be at the end of this thing. We've got a 4-day boot camp next week, and we're not going to have $15,000 of credit card charges as you walk out the back door. These are people that are active in the space every single day, and whatever the topic is, and really we're here to tap their professional knowledge, not the thing they're trying to sell you to make money off of you. And any FIBI you go to, our club or anywhere in Southern California, that's the same vibe, right? People are just there to give you information. So tonight we're going to be talking about creative ways to fund your real estate deals. We do have some questions that we've put together, but this is meant to be an interactive forum. So if you have a question, raise your hand. We will try to get to as many questions as we can. If you need to stand up in the back, we kind of leave some space in the back. Some people, it's hard to sit still for an hour and 45 minutes. We get that. Stand up, walk around the back. If we still have some drinks and food here, so if you want to grab something, just go around this side back, this door back over here. You can get back around and grab coffee or beer or wine, whatever you're drinking. We have our meeting next month, which will probably be going up later on this week. In May, we're actually going to be talking about just some interesting investing strategies. So the guys that started FIBI, Matt mentioned Jeremy Roll and Ellis San Jose are people that started FIBI about 10 years ago. And last year, Jeremy actually was a 10-year, he had been out of the corporate world as a full-time private investor. And to celebrate, he wanted to go to Las Vegas, which if anyone knows Jeremy going to Vegas is like grabbing a bag of pennies and getting on a plane and going to Las Vegas. He's a very, very frugal guy, terrified to make any kind of bet on anything. And so
he's going to love you, right?
He's going to love it, yeah. So last year we had a group of us that went. It was Matt, it was myself, it was Jeremy, a couple of other guys, and we just talked about investing in general and things that we're all doing. It ended up being this really interesting conversation. So next month, we're basically going to take our Vegas group off the pool, put them up here on a panel, and we're just going to kind of do a roundtable discussion on things that we're all currently involved in advertising or in real estate investing. So super good panel next month. Actually, for Matt also runs the Long Beach group, and where are you going to be this month?
I'm going to speak in Seattle for like 600 people.
That's cool.
Cool.
All right.
It's called the PNW Big Badass Real Estate Event, networking group or something like that. Yeah, it's crazy. It's like this guy named Tarl is throwing this, and it's like a 4-day event, and there's going to be all kinds of amazing, crazy speakers there. They're doing all kinds of stuff. He has me talking about taxes, of course, so that's going to be fun. So, yeah, I'm like, I got to make that lively. I'm like, look, you can make this kind of a return inside your 401k. Awesome. So, which is, it's pretty cool to be able to do that. But at the same time, like,
no, that's enough. That's enough.
There's going to be some great speakers there.
It's in Seattle. No one's going to go. Yeah. So anyway, Matt's big time now, going to speak in front of 600 people. So actually, I'm going to be running his group later this month in Long Beach, and we're going to do a speech on investing with the housing shortage here in Southern California, how to profit off of the housing shortage in Southern California. So that's going to be April the 26th. The way we run this, obviously we're not making money off of this. As Matt mentioned, we are an official nonprofit for FIBI. So any money that we make from here, we just invest it back into the brand of FIBI. And the way we kind of fund this, because clearly your $20 isn't getting us to the finish line here, is we do have a couple of sponsors that we want to acknowledge. So first of all, UDirect IRA. Actually, Karin Hall here is the owner of UDirect IRA. And we're going to talk a lot tonight about self-directed IRAs. But they're one of our go-to companies for anything self-directed. So if you have any questions on that, make sure you talk to Karin after the fact. New Western? I didn't see. He's not here. No. So New Western Acquisitions, they are a wholesale firm, and they basically do wholesaling on a corporate level. Where's Andrew at? Mr. Westling back there. Walker Dunlop, they're a commercial lender. They're not a bank. So his company is a sponsor for us. The Note Assistance Program, those guys do a lot of note investing, both performing and non-performing notes. They're sponsors. And then Spiro Woodward is a local firm here that in Redondo Beach that does real estate and business transactions. So they're one of our sponsors. So if you need a referral on any of those kinds of people, please let us know. We've got some really good people that sponsor the group. And the last thing I will tell you before we do introductions here is that this is purely for conversation purposes. Please do not take this as investing advice. While we do have an attorney on the panel and Matt claims to be a CPA, this is not meant to be legal or tax advice. So, anything that comes across through here, we recommend that you certainly check with your own personal advisors before making any kind of real estate investment. Anything else?
I think you covered it. I'm tired of listening to you already.
I'm tired of listening to me as well. So, all right, let's start it off. Robert, why don't you do an introduction of who you are?
Sure. My name's Robert Fregoso. I've been in the business now for 29 years. Started off, what we came wholesaling. I didn't know that at the time, but wholesaling, went into apartment building syndication and house flipping. Started a hard money company with a few guys and built that up for 17 years. I got bought out in 2014. Messed around for a couple of years and then kind of got back into flipping.
That guy's probably the guy.
You know something about
How's retirement right now?
Yeah, it didn't go so well.
Yeah,
it was kind of
flipping. You still got the bug then.
Still flipping. Flipping's great. It's awesome. It's kind of my artistic outlay for things and houses, and we've kind of created a new style of house that is getting a lot of traction now. So it's working out pretty good.
Hi, I'm Karin. What do you want me to say here? What do we do? Hi, I'm Karin. And my company is UDirect IRA Services. And so what we do is help people take their retirement and invest it outside the stock market, which, what's the stock market doing today? Did it go up or down? I didn't see. It's been kind of volatile, right? So, it's going to be crazy. So if you're a real estate investor and you think, hey, this is the asset class I really understand, that's the number one asset class people use in their self-directed IRA is real estate. So you've got the choice of putting your 401k money, rolling it over, or your IRA money into the stock market or into assets that you know and understand, like real estate. And that's what we help you do. So you open an account, you fund it, then you can invest in everything we're going to be talking about tonight, real estate, syndications, private notes, precious metals, and that's what we do at UDirect. So, yeah.
I followed instructions. Good evening, everybody. My name is Carol Glover. I am a real estate attorney for about 28 years now. I wear 3 hats. I'm a broker. So I do real estate transactions. I've done some brokerage work as well as do a lot of transactions for my own account. But I've also helped clients with just buying and selling homes, investments, apartment buildings. I am a real estate lawyer. I'm associated with a business firm here in town, and so they handle the business transactions, which I also used to do. But I exclusively handle commercial real estate transactions, which is purchase and sale and leasing. And then I also, with my partner Dave back there in the back of the room, I have a development company. So we flip properties, and we've done value add for apartment buildings, a lot of residential in the greater South Bay area. We kind of joke that we have a chain on the bumper of our cars. We don't go too far afield. We don't do out of state flipping. And then we also had just recently completed a commercial renovation in Hermosa Beach on PCH, which was interesting, a lot of fun, a lot of challenges, but I like it. I like commercial, so we're going to be doing more of that.
I am Matthew Owens. I'm a California licensed CPA still, even though I won't do your taxes. It's no fun doing taxes. I don't like to pay the government any more money than anybody has to. So anyways, there's my libertarian side of things, Dave, for you. So I flip probably about 5 to 10 houses a month. I've done over 600 now in the last 10 years. We do a lot of value-add multifamilies. We invest in different syndicated investments like self-storage and mobile home parks and different other multifamilies. We also lend capital, do short-term rentals, and do quite a bit of different strategies in real estate, including, non-performing notes and things like that too. So try to get different income streams going in different ways to completely, solidify cash flow streams and stuff like that. So it's a lot more fun than doing taxes.
Isn't everything more fun than doing taxes? Yeah, right. My name is David Coe, so welcome to our office here. I'm a Keller Williams agent, and we specialize working in the greater South Bay. But we also work with a lot of investors. And myself as an investor, I've done everything from non-performing notes. I'm a partner in a new construction development project up in North Hollywood. Invested in a lot of the syndicated stuff that Matt was kind of talking about. But we really work with a lot of residential investors. So actually, Evelyn back there is part of our team. So if you are a residential real estate investor, we'd love to know who you are, what you're doing, just to see if there's any synergy that way. So before we kind of jump into the panel, we're going to go for about an hour and a half, which we have a hard stop at 9 o'clock. Mostly because we've got a cleaning crew that on this night, they have to wait for us to be done. So as soon as we're done, we're going to have everyone walk across the courtyard over here to North Italia. We've got the whole patio reserved with food. It's a cash bar, but we have pizzas and all kinds of stuff. And really the magic of FIBI will happen at North Italia. So as soon as we're done here, we're going to ask everyone to kind of walk over to North Italia, and then we'll pick up the networking over there. So okay, so let's start off with Robert. I'm going to kind of throw this first question to you, and what I want to kind of talk about is just in general the way when you guys are doing your fixing and flipping, what are some of the more I'll say, general common ways that you'll structure real estate deals?
So most of them are either cash or they're leveraged to some degree. I have a bank line of credit that's a more traditional line of credit, and then also a hard money line of credit with my old company. And I'm always kind of chasing yield, so I look at what the best yield will be. And if it's quick turning deal, then it might be something that we do cash. If it's something that we're going to fix up, then the yield might be better if we leverage it a little bit.
You're saying we. Who's we?
So I do a lot of partnership deals because I'm not out there really pounding the pavement anymore. So it's generally either a investor like yourself or a real estate agent or someone that brings me the deal. And so for the most part, that's kind of how I get the deals. I'm not out making offers and kind of meeting with homeowners or doing things like that on my own anymore. Most of them come in a partnership facility. There are a lot that I end up doing, but someone initially brought me the deal and maybe they need money, so they'd rather get bought out of the deal. And essentially they'll act as a wholesaler and sell me the property.
Do you do, like when you'll structure with the deal with them, is that more like a partnership, a joint venture? Will you create an entity, all of the above?
No, so generally I take title. We have an agreement, like a joint venture agreement, and I'll be on title. It depends on the structure, and the structure varies from sometimes we've done a partnership with the seller because they want to end up with more money, and sometimes they're realistic, and if they're unrealistic, we try to get them to as close to their number as we possibly can. And so, there's sometimes where there's it might be a 50-50 split with the seller, and then I'm splitting with the agent, and the commissions are part of it. So we end up making a little bit less. But right now, at this cycle of the market, I'm a bigger fan of making a little bit less money, but having safer deals to be a part of. And so I like knowing that we're going to make money versus having to stretch and then having to be the highest comp. We're usually the highest comp anyway, but if the market changes, we still end up making money. Whereas, if you're buying it, then you're in and all of the liability goes towards yourself versus, dispersing some of that.
It's a great strategy, by the way, in real estate investing. If you can consistently not lose money, you're generally going to be okay.
But if you buy low, sell high, it works almost every time.
Karin, what about you? Like, I know you've got all kinds of creative structures that you're seeing through the self-directed IRAs. Why don't you give some idea like what that looks like?
That's the thing. When we're investors, we're creative people, right? We're always looking for a way to make a deal happen. And so with self-directed IRAs, creative structures aren't always the best thing. I mean, self-directed IRAs have rules. Maybe we'll get into them. Maybe we won't. If we don't, call me and we'll chat about it. But with self-directed IRAs, we don't want to see a lot of complicated deals, right? I mean, whatever we get, we look at. We review hundreds of different kinds of deals every day, and if it's like your thumbprint. Everybody has a different deal. It's written differently. But like if it's a note, for example, if it's a note investment, we want to see the basic elements of a note: that it's got a principal amount, that it's got a rate of interest, that it tells us when the payments are going to be made, that we see at least one interest-only payment a year, and that there's a maturity date. So those are the basic elements of a note. Am I right? But we get napkins. I mean, and God bless you guys for being incredibly creative investors. But with the self-directed IRA, this is precious money, your retirement money. It's you're limited how much you can save, and you want to get the best return. And with self-directed, we don't tell you what you can and can't do, but we can tell you what is and is not administratively feasible for us. Like as a business decision, what assets we will and won't custody. So that's kind of a question. So we see, the kinds of deals you're talking about. So the equity participation deals can lead to tax. Did you know if an IRA invests in an equity participation note? So do you know what I'm talking about? So there's a rate of interest plus an equity kicker when the deal closes, right? That can lead to a tax. You want to discuss it with your tax advisor, called UBIT, unrelated business income tax. What if you didn't know that? What if your IRA did that kind of loan, you didn't know that? Well, that's why you want to call us, because we're going to look at it and say, hey, guess what? Did you see this? Did you discuss this with your tax advisor? Did you pencil out the numbers from beginning to end? Is this, so here's the information, and this is what you need to ask your CPA, and let us know what you want to do, So we see, creative, but only so much gets through.
So, Karin, I know that we're talking about self-directed IRAs, but there's other kinds of retirement accounts you can self-direct. Like, what other types of retirement accounts are people using to invest in real estate?
Yeah, that's a great question. So self-directed IRAs is like an umbrella term that's the traditional, the Roth, the SEP, which is a simplified employee pension, Simple. By the way, when the government calls something simple, okay, it's an acronym for the Savings Incentive Match Plan for Employers. It's out there. Not many people use it. We hardly have any, but you can use it. There's an inherited IRA. If you have an IRA, you name a beneficiary, you pass away, your beneficiary gets an inherited IRA. And there are lots of rules with that. A spousal IRA, it's a regular IRA, but with normal IRAs, you have to have earned income in order to contribute. If you're a non-working spouse of somebody who is employed, you can contribute to an IRA even though you don't have earned income. It's called a spousal IRA. It's really just a traditional or Roth that you contribute to as a spouse. So those are the kinds of IRAs that can be self-directed, and also a 401k for individual business owners. So that has a lot of bells and whistles, and it's really cool. And if you're self-employed with no employees, maybe we'll get into that later, but it's a 401k for a business owner with no full-time employees. It can be a business owner and their spouse. It's interesting because, but that's true. So that's a solo 401k.
Carol, what about when you guys are, you see all kinds of stuff, I'm sure, both as an attorney, but also for your own personal stuff. Like, what's your guys' preferred method that you do when you're looking to buy something, and how do you work with investors, and how do you structure your deals?
Well, pretty much the same way that Robert talked about, in that we usually have, we fund a 70% loan to value, and so that's the loan part of it, and then we seek the rest of the capital, which is the composes of the down payment, and then also we weave in our construction budget, and so we have the total purchase price plus our construction budget, and that's how we purchase it, and we. Depends on the deal. We've done a bunch of different things. We've done notes where they just get a interest rate, our investors. We've done notes where they get a kicker at the end and participate with us in the deal. We've done joint ventures with owners who have been in trouble. Either they need to sell or they want to sell, and they understand that their property is not saleable in its current condition. So we've done joint ventures with them where we've contributed cash to the deal, and they've contributed property, and then we do the renovations, and then we split it at the end on some ratio. Those are I like doing those. Those are very interesting. It's a little bit tricky in that you do have to establish the value, and you have to get agreement from the business owner as to what their property is worth in today's market, unfinished, so that you can properly work out what the profit is at the end. And there can't be really any dispute about it. It has to be set in stone, because you can't have an owner coming back after you. Well, I think, when we started out, I really had more value in there. So that's part of where the documentation comes in really documenting your deal. I am a real estate attorney. I do document all of our deals. And I haven't gotten a napkin, but I've gotten close. I've gotten close to a napkin. And a little tip, a little bit of advice for dealing with attorneys on this in terms of what your deal is. Honestly, if you just sit down and get your calculator out and work your numbers, but then you also work through thinking about the deal flow and what your intent is. And I know this sounds super simple, but believe me, people don't do this, and you get all kinds of strange arrangements that don't make any sense. So help your attorney out and save yourself some money by just sitting down and actually thoroughly writing out. And it's not, here's the parties, here's what we're going to do, they're going to invest, this is the labor, here's our contractors, here's what our expectations are, and just go through that, and that'll save you a ton of money. So.
Yeah, if I can add something to that, because I'll tell you, one of the biggest things when you're doing partnerships with especially sellers involved is you don't want to do it with all sellers, in that there's some sellers out there that you're waiting for the lawsuit to happen. And so you want to make sure that it's someone that seems reasonable up front. And it's just like Carol said, is you outline everything. And now I highly suggest that if you haven't done one yet, that when you do, you involve someone who has at least more experience, and maybe not all of the experience, but more experience, and has done one, only in that there's so many different scenarios that can arise that, your biggest risk is generally what you don't know. And so having an attorney or having someone who's got a lot of experience with that helps kind of breeze through all that.
I think that's extremely important, especially for the communication up front, with the homeowners, or even when you're raising capital on a deal with an investor. We had an investor one time that yelled at us because he got his money back. he got paid off. He signed the trust deed release to release the loan from the property. The escrow sent him the money back, and he called the closing agent saying, I need to have my money reinvested immediately, and I'm freaking out. And he's screaming at the closing agent. I'm like, well, I can't do business with you anymore. Now it's not going to be invested at all. So, but I mean, just because you can do business with somebody doesn't mean you shouldn't. And I think, Robert's right and Carol's right with regard to the paperwork involved, making sure that's outlined and clear up front, and you kind of gauge the craziness of the person you're dealing with, because there's some crazy people out there, and especially when you're talking about dealing with money. So, my brother used to work as a teller, and he just shook his head like in college. He's like, this is ridiculous. People are nuts with their money. They're crazy. So, be careful when there's emotion involved in those situations whenever there's money involved. So, having that correct outline and that correct understanding up front is key. And having standard template documents that you can do, understanding the full scope of what you plan on doing in the future, will save you a ton of money as well when you're structuring these deals.
Yeah. Also, we used to always say, it's like 1 in 5 people is really crazy. So look around.
He's just mad because I beat him at golf last time. So who here is actually looking at trying to raise capital for a deal, or just line up capital for their deals in the future? So,
by the way, It should always be everyone in the room, right?
Yeah, you should be constantly looking for capital, and if you have capital, you should be constantly looking for cheaper capital. Because that bottom line number, when you're doing a lot of deals consistently, is substantial. It really adds up. I mean, I don't know if it's one less point or one less, interest rate amount. It's going to add up substantially. So, constantly getting out there and developing your relationship base with investors is key. But then you got to deal with sophisticated and non-sophisticated investors. What are some of the things you've dealt with, Robert, on some of the investor side and issues that have come up when you're raising capital from private investors and things like that? I know you have larger lines of credit and larger, sources now, but, what do you see people go through?
I remember firing some investors, and because you do have some investors that are just very difficult to work with. I remember one in particular that the docs had to be perfect. If you were missing a comma somewhere, he wanted all the docs to be redone. And, and we ended up, you work with those guys when you absolutely have to, right? And then as soon as you raise other capital, they're the first to go. And they don't realize that they're actually costing themselves money because they lose out on more deals. But you do get some weird setups. I mean, we were very fortunate in 2008 when the market crashed. At the time, our fund was still positive, and so we were, I think, the only hard money lender that still ended up with a positive return, where everyone else was, minus 15, minus 30%, or minus, I heard some stories as high as 80 or 90% off. And so, we really kind of worked very diligently to not just forecast, but also understand the market and the needs of our clients so that we can kind of bridge that gap. And fortunately, it worked out for us. But very easily, it could have gone the other way. So we were fortunate, and we had no lawsuits that came from that time, which I think, it could have happened. But it didn't come without, working, very, very hard and diligent for probably 18 months to work through, a lot of the foreclosures that we took back and really make sure that we met the fiduciaries that we had in place for our investors. Some of the weird stories that I think came up is, I'll use my mom as an example because she invests some of her retirement money and she used to do trust deeds and then stopped and then she told me, I think it was 2 years ago, I've got to open up the CD now or a new CD and they want me to do this. I'm like, why aren't you still doing trust deeds? She's like, well, because you haven't been doing them anymore. And I said, oh, well, all right. I said, well, you know what? Why don't you come in as a second behind wires and I'll give you 20%. And she's like, great. Okay. Sounds great. I pay her off. And then she tells me, no, that's too much money. it's too risky. And I said, listen, Mom, the risk is over when you're getting your money back, right? I just want you to understand how this actually works. And she actually gave me like half of the money back. And so I still, well, actually, I don't even have the check with me, but I used to carry it around with me because it's, again, I've never cashed it because I'm like, yeah, right, good luck, right?
But see, that's exactly what I'm talking about, though. There's completely different levels of sophistication when it comes to these investors. And some of them, if you're not teaching them right up front when you're raising capital, you're going to find out that you're going to have some crazy people or people that didn't understand the situation that aren't crazy, that just don't know about investments and how the collateral works or what happens when there is a downturn or an issue. What do they do and what are their rights and how do they protect you?
The other big thing that would happen a lot when we were raising capital is that we were raising capital, and at the time, we were offering like 9-10%. And the amount of people that thought the risk was too great that would take the exact same investment at 6 and 7% was amazing, right? Same deal, same deed of trust. We made more money. It's perception. It's too, like, just like my mom. It's too risky at 20%. There's no, risk is over, right? You got your money back. So that's what happened. You have to understand, and this is a lot of just really understanding who either your investor is and what their needs are. If they're in growth state, they're looking for more returns. If they're in, just kind of hunkering down and get a return, and they're if you offer them 15% versus 7%, it's probably hurting yourself versus helping them.
Yeah, and Matt was talking about like making sure you properly explain the money. Usually when you're fundraising to a deadline, right? There's an escrow close date. Something's happening where you have to raise money a certain period of time. It's real easy to kind of be loose with the information just because you need the money. You're trying to close. And that's where you get yourself in a situation where you may close. It's after the fact that you realize, wait a minute, they didn't really understand what we were talking about. They didn't necessarily understand the paperwork that we were going through. And then all of a sudden there's a problem. And now you're in the deal. And those are a lot harder to unravel once escrow has closed. Instead of maybe, you know what, I don't know if you're the right person for this, and moving on and finding another investor. Speaking of, self-directed IRAs in particular, there's so many different ways of people either using their self-directed IRA to fund deals or using their self-directed IRA to fund other people's deals as lenders. So kind of talk about a little bit of what that looks like from the individual IRA holder's perspective.
I'd really like to. I think because, we're talking about, like you're talking about investing with your own cash and when I'm talking about investing with retirement dollars, well, these are obviously precious dollars, as I mentioned. But when you're raising capital from a pool of, guess what, $27 trillion in America that's in retirement money. And only like 3% of that is invested in what's called alternative assets, meaning housing. Like, how's a house an alternative asset? But it is, okay? Or non-correlated assets, not correlated to the stock market. So this is the question that you ask when you're raising capital and you want to use self-directed IRA money. You say to them, do you have an IRA or a 401k with the previous employer? And they say yes, and you go, great, because did you know you can take that money and invest with me? Like, what? No, you can't. No, the stock markets, you can only invest in mutual funds, or, with the IRAs are just for mutual funds. So it's a common misperception, but I'll tell you what, you've been able to self-direct for 43 years now, since who was alive when Gerald Ford was president besides me? Okay. Right? Okay. So that's how long ago it was. Gerald Ford, he signed the ERISA laws into effect in 74. They went to effect in 1975. Who wasn't born in 1975? Just love to know. Okay. Oh my gosh. Love you. Love you so much. So for some of the people in this room, for your entire life, you've been able to self-direct an IRA. How do you like that? But it's like a best kept secret. It's like a best kept secret. So you tell your investor, hey, do you have an IRA or do you have a 401k with the previous employer? And they don't know anything about it. So you're opening their eyes to this new possibility. And you'll hear people speak negatively about investing in real estate with a self-directed IRA because there are rules and restrictions, and you absolutely, like any investment, need to know what you're doing up front, right? And that's true. So if the question is, and you as a tax person get this, if I have a bunch of money in my checking account and a bunch of money in my retirement account, and I want to get this property. Which one's better? And Matt, you're going to probably say, use your personal money, right? Because you might get the best tax results or the most write-offs. That could be the case. But there's a different question. If the question is, I don't have a bunch of money in my checking account, but I used to work at Boeing and now I've got $500,000 in my 401k. Now the question is, do I put that in the stock market or do I put it in real estate or some other asset class that I understand? That's a different question. And so if that's the question and you choose real estate, that's what a self-directed IRA is for. It's a vehicle, just like we're kind of like, not exactly, but kind of like escrow. So you bring a deal to escrow. Well, escrow doesn't tell you if it's a good or a bad deal. And they don't tell you whether you should or shouldn't do it. Or, oh, my friend has a different property. Why don't you buy this house over here? They don't tell you what house to buy. They're simply following your instructions. Hi, I want to buy this house. And they take the paperwork from where it is now, move it on through till it's now closed and funded and it's your property. We're something like that. I mean, it's a pretty close analogy. We're not, changing title or anything like that, but we're administrative. Taking the money from where it is in your retirement life, in your account, moving it forward to a self-directed IRA, and then investing those assets as you direct. That's why the company's named that. Investing the assets into the assets that you choose. So we just sent the money over here. 100% of the proceeds have to go back in the IRA that owns the asset. And this can blow some people's minds, but 100%, yes, of the expenses have to be paid for by that IRA. So you know what we've had people buy rental properties with their IRAs, and here comes the rent check, and they just put it right in their own pocket. And so this guy called us and told us he did this, and we said, what? He says, well, I claimed it as income on my income taxes. That's okay, right? So that's called taking constructive use of your IRA. And that means, so when you commit a prohibited transaction, that means your IRA is not an IRA anymore. It's like you just earned that income. So that's game over. So a prohibited transaction is game over. Maybe we'll talk about it later tonight. But that's why when you call us, we're going to say, hey, what's your name? How do we get a hold of you? And how'd you hear about us? But we really want to talk to you. We'll go in depth as long as it takes. Tell us about your deal. Who are you investing with? What's your deal? What's the structure? And we want to hear this before you open an account, because we don't want you to open and fund an account and then find out that you can't do your deal because it's a prohibited transaction. You see, so there are rules. So we'll get into that more, but there you go. So we give you an opportunity to tap into that. I just got back from DC, so we got the new number. I remember when we started this 10 years ago, it was like 18 trillion. Now it's $27 trillion in America in retirement. It's like IRAs and 401ks and pensions and so forth. So that's what we help you do.
It's one of the biggest funding sources that you can utilize, and also utilize for your own investing. There's so many different things you can do inside your own, 401k or IRA that can really, you want your juiciest deals inside those types of accounts, if you can, to try to use that for retirement, to get that high enough to where you can use it to cash flow off of to retire. So we have a question here. Quick question. Yes.
That's a really good question. I mentioned I was just in DC and we had a whole a breakout session about this. I'll repeat the question. The question is essentially, can she invest her IRA in cryptocurrency, right? Right. So are there regulations about Bitcoins and self-directed IRAs? So we talked about this, right? So all these people in this group, they own trust companies, or they're like UDirect, and we're all in this room together. So there are really two ways to do it. One is to take an IRA-owned LLC. That's where your IRA opens a special purpose LLC. And that's essentially, we can go deep on it, but we'll just leave it right there. And then LLC opens a wallet, invests in cryptocurrency. But there are other companies that will have cold storage, right, of this cryptocurrency. Well, so one of the guys was saying, one of the trust company owners was saying that he bought one of these little devices for cold storage, and he realized the incredible amount of liability that he had. Because if you get these codes off by one digit, you can lose someone's money, and it will never be found. It's in the blockchain. You'll never retrieve it. So, and he also didn't like having this cold storage. It's a device. It's about the size of this microphone. And what if there was a fire in his house? And could he get insurance? Does he have insurance covering if there is such a loss? Human error. Do humans make mistakes? No, they never do. Okay? So before I would invest my retirement dollars in cryptocurrency and somebody that's going to keep it in cold storage, I want to say, let me see your insurance policy. Because if there's a human error, what are you going to do about it? That's what I would ask. But if you're doing it with an IRA-owned LLC, it's you and the cryptocurrency wallet. You know, what do they have? Kryptonite is one of them, and there's Coinbase, and there I think like so many different kinds of these wallets that you can invest in, and it's just growing. And it's a big point of contention with the SEC. They're trying to monitor it and, you know, look for fraud. So can you do it? Yes. Is that a long answer? Yes. So it's either cold storage or your IRA is using the LLC to invest in a wallet that way. Yeah, I think, like, I have one of those accounts on my cell phone, right? It's called Coinbase, because I thought, well, I want to understand it. And by the way, there's a really great thing on Netflix. If you just put Bitcoin in your Netflix thing, there's a great documentary on this. And by the way, the day it came out, Bitcoin spiked. That correlates with the spike. But if you want to understand Bitcoin and what it is, and cryptocurrency and blockchain technology, do yourself a favor and look into that. So what you're talking about, day trading, I mean, that's when you're using a wallet, when you can do those trades real quick. And so again, that's if somebody wants to invest in cryptocurrency with us, they use the IRA-owned LLC. You, as the managing member, are opening a wallet in the name of the IRA because it's an IRA-owned asset, and so you have to title it correctly. And there you go. So I'll tell you, it's a new frontier, and we've got a lot to learn. There's a lot of learning to do about cryptocurrency, about how it all works. So it's early days on that asset class.
And I think it's important to understand too that, like, if you're going through and doing the cryptocurrency and you're doing day trading, it could be construed as running a business inside your own retirement account, in which case it's subject to unrelated business income tax, which is pretty high. It's like, what, 40% or 50%, I think, right now? I don't know. Yeah, I don't know that. I don't pay it, so I don't pay it. But yeah, I don't run a business inside my own IRA. So what's the tax rate right now on
it just hurts me to say it. I don't know if I can say it.
It's 50% or something,
I don't want to hurt
49%.
No, it's the same rate as a trust rate, which I believe just changed. So I think it's 38%. Am I right?
Okay. Yeah.
So it's 38%. But let's go back a little bit. And you're the CPA, so you correct me. But if your IRA owns this tax, you get to actually take deductions. So if your IRA is going to pay this tax, it's going to file a Form 990T. Like you and I, we do a 1040 when we do our taxes. If an IRA does own tax, it files a 990T. So you talk to your tax advisor, and they're going to take deductions off of it. So maybe this isn't the worst thing that ever happened if you've got expenses to offset the tax, right? So you just want to pencil it out. It's not the end of the world, but just pencil it out and see after this tax, does it make sense for you?
And I think it's important to really understand self-directed retirement accounts for that capital raising component, just as much as it's important to understand, the paperwork behind a deal, and so and how to structure it correctly so that you can explain it to your investors. And I think most people get the wrong information about this. And Carol, can you kind of, probably one of the simplest ways to raise capital is through the form of a promissory note or a joint venture or something like that. What are your thoughts as far as, can you kind of explain to people what typically goes into the paperwork on a promissory note? If a borrower came to you or a lender came to you and wanted you to help them understand what are the major documents involved and how do they get protected, can you kind of explain that so that everybody here kind of understands it?
Sure. So, Karin gave a great explanation of a promissory note previously. You have to have the amount, the date, the repayment, what the interest rate is, and you have to identify the parties. And then promissory notes that we do on our deals, if we usually have we've done it a couple different ways. One of the ways that is a very simple way to do it is, let's say you go to a hard money lender and you have to then sign a promissory note to the hard money lender, and they take a security interest in a first position on the property you're buying. And then maybe you have additional investors who are going to help you to fund the balance of the transaction, which would be your construction budget and your down payment and contingencies and everything else. So what we've done is we've taken our pool of investors, or maybe at times it's been one investor, and they also get a promissory. They get a promissory note where we promise to pay them the money back, and then it's secured again with a second against the property. So then the project goes through, the renovation goes through, and then the property's sold, and both parties are paid off. So that's just one of the simplest forms. If you're going to do separate pool of investors and maybe a hard money lender, or maybe you, maybe you have not a hard money lender, maybe somebody has funds that will do it for a lower interest rate for you, another friends and family, and then you have another pool. But that's kind of one of the simplest ways we do it.
When does an investment become a syndication versus... I told you I was going to ask that question.
Yeah, I'm not a securities attorney, but really when it's not a straight note and there is a kicker on it, it really is a security. Because it's not just a promise to pay at a certain stated rate. What you're doing is you're promising to pay at a stated rate plus a bonus at the end. And that bonus fluctuates based on what your deal is and how good the deal turns out. And so that is a risk, and it is considered a security. So if you're going to put a kicker on it, then you might want to talk to a securities attorney, where you set up what's called a private placement memorandum. So the documents that you would have in that deal, instead of just a simple note and a deed of trust that secures the lien against the property, what you have is a prospectus for your deal. And then you also have a private placement memorandum, which is a comprehensive document which really lays out what the deal is, who the parties are, what your history is in terms of transactions, how the deal's going to be structured, how the payoffs are going to be, what the length of time, can you get out, how long is your money committed. And so that private placement memorandum is something that investors will look at. But what's key here is that there's qualified and accredited investors, and there are non-qualified. So accreditors and investors that are able to invest in a deal under a private placement memorandum that is exempt from securities regulations, like doesn't have to go through all the bells and whistles and hoops to be registered with the Securities and Exchange Commission, which is that's what public companies do, and that's outrageously expensive, and you never do that in one of these deals unless you're a huge company. But if you have to qualify your investors. So if you're out there raising money and you're doing a private placement memorandum, because you're giving a percentage, you're giving a profit to these investors, then the rule is that your investor has to have at least $1 million worth of assets other than their personal residence, and they have to earn more than $200,000 individually and $3 as a married couple. And so many people will go to an attorney, securities attorney, they'll develop the paperwork, and then the attorney can also do the accreditation for you. So that it's an independent third party that is going through the prospective investors' financials, so that you as the operator and of the investment doesn't have to do that. It's that's a little more comfortable. It's another layer there. So those are accredited, non-accredited. Or you can do, I don't do crowdfunding, but that's another way to invest. If you have a deal and you have a history and you can prove that you have knowledge in the industry and that you have a track record, you can go to one of these sites and have them vet your deal, and then your deal is put on their websites, and people can invest as little as $5,000 or $10,000, which is a great vehicle. I've never done one of those. I'm thinking about it, but I've never done one. Have you done that?
Expensive depending on who you're going to. So, and a lot of times now they put you on a platform and don't do necessarily any marketing, where they can leave it up to you. There's a lot of service-based platforms now, which is really interesting. But a lot of those, they'll raise money off of the capital raise as well. I've just seen it be a little bit more expensive than traditional, just because you're dealing with more professional investors, and the crowdfunder needs to make a spread too. So.
Yeah, also, I mean, the crowdfunders if you're looking at basic flips, are really, I think, in large part, really cost prohibitive. And you might as well just go to a hard money lender that's going to give you a yes or no versus I think most of the crowdfunders that are in the hard money business are really glorified hard money lenders, right? And they're using the term crowdfunding because it's fancy and new and people think it's sexy or what have you. Really, they're just a hard money lender. And, you'd be better served going to a hard money lender and knowing right up front if your deal's going to happen versus, just think about it. You're putting out deposits, you're doing all this, you're making commitments on maybe the crowd is going to fund your deal, right? You're better off having someone who says, let's do that deal, let's go. And that works a little.
I think that the single family home flip space is not where you go for crowdfunding money
or syndications.
You go there. Yeah, you go there for large commercial deals and things like that, or stuff that you may not be able to raise separately, yourself.
Yeah. Sorry.
I've been going on those sites. I'm just been curious about doing one of our deals, and there are a lot of residential flips there, which amaze me. Yeah, a lot. Just wading through that as an investor, I just can't imagine having $5,000 and spending days like plowing through all that stuff online. Going back to people and investing, instead of spending my $5,000 plowing through all that and going to a kind of this anonymous crowdfunding site, I would rather kind of pool my resources and pull together my money and go to organizations like this and really get to know people and know who you're dealing with, and then invest in a single up deal.
There's a rule in investing, right? You're never supposed to be the first investor in, right? You're supposed to let someone else take all that risk and learn the curve and all that good stuff, and let somebody else pay for that education and then come in and make all the money.
In IRAs, what we see a lot of different ways of investing. So I think just to kind of like recap what everyone's saying, you can invest it as a note as being the vehicle, or a private placement, and the private placements come in a Reg A, Reg B, Reg C, which is crowdfunding, and Reg D, which is we see the most commonly. So that's a Securities and Exchange Commission governs that, and FINRA governs these offerings. So if you're going to invest in something, you can do it as a note where it's a debt. You've got your IRA as a debt position. In my case, it's your IRA. Or you can invest in like this Reg A, B, C, or D, where your IRA has an equity position, or could be debt too.
Yeah, really, the debt structure is the easiest way to raise money. If you just have an investor and you either have, let's call it an A and a B piece, and your A piece might be a hard money loan or an investor like myself, and a B piece might be a secondary investor for that gap. Or there's gap lenders that do that as well. That's the easiest structure for most transactions before you get into something that's much more sophisticated, like a syndication. Syndications I have found that work well for apartment buildings, in that, generally there might not be a set rate of return, and all of the income, the resale at a set time, all of that goes into their return. So you have the expectation of a return. But one of the first things in a syndication that says is you can lose some or all of your money, right? So if you don't understand that and you don't have a lot of money to invest, and that's literally the first line that is in bold print before you even turn the page, you're going to think twice about it. And so if you're just starting out in either a single family space or development space, there's a lot of other vehicles to use. One of my favorites, I think, would be probably just if you have enough funds to have closed the deal already, that you securitize a note for your own money, from a different entity on that, and then try to sell that note, and you'll meet a bunch of investors, because even if they tell you you're crazy or I want to buy your $100,000 note for $10,000, it doesn't matter. You're meeting more people with money. So it's just, and then build up your database from investors from that standpoint. So there's sites that are out there that are
a great way.
What
other ways do you think? I mean, networking has always worked for me for raising capital. But what are some of the ways? That's a great strategy for raising capital. Are there any strategic ways you can market for capital and things like that?
Yeah, I mean so marketing for capital is tricky, right? Because you're not supposed to actually market for capital unless you have capital to sell, like a note. And I know the rules have changed, especially since I've gotten out of the business, with the Jobs Act and everything. But from just a simplistic form, if you have a note to sell and you put it on a site that just sells notes, you're going to meet people that are already interested in investing in real estate, right? So that's the easy, low-hanging fruit, rather than try to convince someone who is a doctor and trying to convince them that real estate is a great investment and their parents lost their house in 2008 or something, right? So the other thing is sellers, by the way, are a fantastic source. If there's a lot of sellers that sell. They just had a good experience with real estate because they cashed out all of their money. And sometimes they are now accredited investors if you have a fund, or just might be someone that you meet. And it's the same way if you market a note for sale. It's kind of the loophole that you're selling a note. You have a tangible asset that you're selling versus just asking them for money for no reason. Now, they don't have to buy that note, right? If they don't buy that note, hey, we have other things that are coming up, and then that kind of opens the door a little bit.
One strategy I heard about recently that I thought was brilliant was to actually go to, if you're trying to raise capital in a certain market or something like that for your deals, and you're focusing on a certain farm area, to literally go through and pull the data reports from title companies for all of the private lenders that are recorded against properties specifically, and pull all the mortgage holders and get rid of all the banks and the bigger companies there, and just start marketing with direct mail and things like that to those specific lenders that they want to buy the note, or if they have other capital they want to invest. And I know a lot of people that are getting cheap financing that way.
So if you do that, a big recommendation is, once you put it on the spreadsheet, is organize it by mailing address. And because a lot of these mortgage companies, right, it'll go straight, but the mail goes straight back to them. So if you see, one address has 200 notes and they're all individual different names, they don't share a house. It's a company that has all the mail coming back to them. Save your mail, save your postage, and just eliminate all of those.
Yeah, you can get tons of lists, but weeding through the list for what specifically you want to market for can be, it's the most important thing. You have no business marketing for this unless you can track specifically your data, because you're just wasting money if you're not tracking correctly. So it can be huge.
Yeah, and one other thing is I don't know, can I just ask, how many of you guys have already done a transaction? Okay, great. That's most of the room, so that's fantastic. Because if you haven't, partner with someone around here and do a transaction, because I guarantee you, one of the first questions that an investor is going to ask you is, how many of these have you done? And if you say, well, this, and you dance around, the question was never answered, and you think you did well, all he hears is bullshit. And so, sorry, but all he hears is just, that you don't know what you're doing. And you want to be able to show, it's like, hey, here's the deals that I've done, here's this, here's my experience, or, I don't, but I have a partner that's doing this, and get that experience under your belt so that you can, not just answer that question, but also so that you can have and hold your fiduciary to that person in high regard, right? Because ultimately, I've always treated everyone's money like it's my own. And if you can't do that, then the problem is that, you might look at a deal biased because, hey, you just need to do another deal. And I'll tell you, the biggest part of investing is walking away from a deal that you think, God, it might be good, but it might not be. And the ones that have a question mark, you don't gamble on when you're using someone else's money. You have to feel, there's already a question mark because of the economy and everything else on every deal at any given day. If you can't feel 100% confident that this is, quote unquote, a no-brainer, and you're using other people's money, you probably should really think about how you're looking at other people's money.
Carol, you talked about putting together a prospectus for a PPM, but I think just in general, anytime you're out trying to raise capital, you want to put together information that you can share with someone who might be interested in it. Can you talk about what makes for a good prospectus or just a block of information that if you're going to share a deal with someone and see if they're interested, what are some of the good components of what that looks like?
I think the components are the same. I mean, you want to that are in one of the more comprehensive, private placement memorandums, but you just do it in a more brief manner. In that everybody wants to know the parties, and they have to know what the subject of the invested is, whether it's you're investing in a note, or whether it's going to be a particular property that is going to be either held for long-term investment purposes with a group of people, or it's going to be a flip. Obviously, the subject has to be there. You have to provide the terms, what the expectation of as a return. Of course, a lot of disclaimers about that these don't always work out well. And then you have to have the data to back it up. Because especially with flipping homes, one of the most critical things is, do you really understand your numbers, and can you clearly talk about the numbers with your potential investors and demonstrate that you have an understanding of the marketplace, what it's going to cost, what your experience is with the contractor. When I'm reviewing a deal, one of my I had this gal come to me about 2 years ago, and recently divorced, had a nice settlement, and she had $1 million, and she wanted to plunk it all in one deal. And so we had a lot of long talks about this.
I love the crowd. Ooh.
and you're probably out there drooling, thinking, why can't I have those?
That is both a dream client and a nightmare client all at the same time.
Well, and what was, and I have another one kind of like that too. So the difficulty in this deal is the things I looked at. I mean, the operator had done this. It was in a certain, they were doing a certain type of deal that they had done multiple times before. Definitely the history was there. She vetted the prior deals and actually interviewed prior investors, and so that was good. And was very determined to do this deal, despite my suggestion that maybe she ought to spread it around a little bit, but very determined to do this. And so then we got down to that, and that was kind of in just the perspective about the deal, just the deal points, what he'd done, what his history is. We researched the operator to find out if he really was who he said he was. And like I said, she interviewed people. And then we got down to the way he structured it was he did an LLC for this particular project. She was investing. They were also going to get a loan. She had a preferential payment at the end to get her money back and a preference. But what bothered me about his operating agreement, because he created this LLC, they were going to be his other LLC and her other LLC were going to be the only two members. So there's just the two entities in this LLC. But there was a lot of things in that agreement that bothered me. As an example, he did a lot of these deals, right? So one of the provisions was that if he wanted to sell out his interest or to somebody else, he could do that, and then he got to sell and he got to pick his replacement manager. And I'm like, no. You can't have all your money in a deal and the exiting partner picking who's going to run the project from here on in. So there was some things like that I really, and he was getting kind of testy with me, the operator, because I wanted to change his LLC agreement. Part of it was he didn't want to. I'm an attorney. I'm a pain, right? Okay, I get that. But the other thing was he wanted to close escrow, so he was getting the tighter it got and the closer it got to close of escrow, he was getting a little tense. But that was the biggest one. Really reading through the operating agreement or preparing an operating agreement that is fair to the parties is something that you taking in money are going to have to consider. And that's part of that list. Is I'm going to circle back to what I was thinking before, what I said before, is thinking through the deal. Okay, I'm taking this money in. It's somebody else's money. What am I going to pay them? What's the timeline? And what happens if things go wrong? Are they going to get their money back? Are they going to get any money back? Are they going to potentially lose it all? What happens if something happens to me and I'm the operator? Who takes over? Do I have somebody in place in mind to be able to run the project if I'm not running it? Disclosing what your budgeting is, your contractors, what your relationships are. I mean, those are all important. If you're taking people's money, they need to understand that you've thought through this and have touched all the points on good times and definitely on bad times if it doesn't work out. And that's what's in that agreement.
And that's called due diligence.
Yeah.
See, that operator, I looked at that, and an operator who would take someone's everything, right, is doing that's where fiduciary comes in, right? You should never put someone in that position, because if something does go wrong and there's a cash call, then he needs more money. That investor also has to come up with more money. So to not leave them in that position, I mean, it's just that's terrible.
That's one of the other things I changed is he also had a provision in there about cash calls, and we put a provision in there to cap it, and he had to look for other sources of funds, and it was a bunch of stuff like that. So it's happening.
So I think it's important, like if you're trying to put together information for investors, right, you may have someone like Carol on the other side reading the deal, because if they are a sophisticated investor and they have an attorney, your documents are going to have to pass muster. And I'd say it's one of the biggest things, like when we're looking at deals, if the docs are trash, chances are they're not a quality operator. It's a huge red flag. So.
And if they're getting emotional with you on that stuff.
That's always a red flag in our industry,
when you start pushing back and asking questions and they start all of a sudden wanting to close
angry,
and they're pushing and they're getting upset, that's a red flag. And
what is it? There's like 7 or 13 things that you can't say in a PPM, right? One of them is like guarantee, value. You can't just say this is the value, especially when you're talking about, an after repaired value. How do you know what the after repaired value is going to be? It's really the market that's going to tell you. So you have to have a third party vet things like. I mean, it's much more difficult to do than just to know people with money.
Right. Question.
So that'd be a bit of a question. So when you're out there, before you do that, I think about is there something that's important to you?
So if I can understand the question, I think the question is there, when you have a potential investor, is there a way to lock them in so that they can't go around you to that transaction and kick you out of it? Yeah, there's non-circumvent agreements, non-disclosures. There's certainly, a big part into just your gut feeling about someone, because a signature means absolutely nothing unless you're willing to fight for that signature and it's right. And so you have to be willing to sue them, right? And there's a lot of people that would just sign anything because they don't care. So someone that doesn't have the moral turpitude to care that they're signing something is probably not someone you want to do the business with anyhow. And that's a lot of it just comes from experience and just a gut feeling that you might have. But you do have to be prepared to go after them if you're going to do. And if it's a smaller deal, you're probably not going to go after them because you're not going to spend $50,000 to go after them and to get your 30. No, I'll tell you, if someone wasn't willing to give me the information as an investor, I wouldn't even waste my time with it. Because it's part of it is a business decision from your standpoint, right? You have to gamble a little bit and be willing to lose some deals to know who not to work with. And at the same time, spread the word if something happens, because, there's plenty of people on Facebook that I see putting other investors on blast or real estate agents on blast because they did something. They didn't get paid, or they, wasn't as promised, and it's a small world. I'll tell you, it's a very, as big as this business is, it's a very small community. If you look at especially investors, right? The investor side, cash transactions only account for a very small proportion of all the transactions. So chances are that gets around. And if you ask your peers in the business, someone may have had a bad experience with someone already.
Yeah, I'd also say, and we'll get a couple questions here, is make sure you got the deal locked up before you start talking to other people. So you don't want to have a deal where you've got a handshake agreement or a verbal agreement with someone, and then you go out and start talking, and now you're concerned about them going around you. Make sure you've got the deal locked up under contract, so even if they do try to get around you, they're not going to be able to take the deal away from you.
Yeah, in the commercial world, I'll tell you, if there's wholesalers in the residential world, happens every day. And it's very common, and there's this common courtesy amongst investors with wholesalers to, listen, if we're making the money, we don't care, just make your money. In the commercial world, they just straight ask us, what do I need you for? And they will they'll tell you to your face, which is, not just refreshing, but it's also, they're going to tell you, we don't need you. You don't have the money to close. We know you don't have the money to close this deal. So why don't I just wait you out and then buy the deal? Then what? They're right. They're not wrong. The difference in the residential world is you have 100 other guys that might buy it. In the commercial world, you might have half a dozen, and they know each other.
Question.
Being due to this operating contracts, so that the operators during the time screwed on this deal by shady investor who sees that, oh my god, stuff is going to happen. Where do we go about that? Do we reach out to lawyers like yourself to find these operating contracts where it's fair to both parties?
Let me go back a little bit. How do you for the back row? The question is, how do you structure a deal, and at what point do you go to an attorney to structure a deal? Let me just back up and take. I don't know what type of investments that everybody's interested in, but let's just say you're going to do a house flip. Okay, so it's either brought to you by a wholesaler or a realtor. And so you put it under contract. So then you've got the property locked down, so nobody can go around you because you have a contract with that seller, right? But then you're kind of under the gun, if you will, unless you've convinced the seller to give you a 4-month escrow period or something like that, which is not likely in this market, right? So then you're looking at reaching out to those people you've talked to who are potential investors, right? So at the point where you have to make the decision, how you're going to do this, is it going to be, are you basically going to 100% finance the deal? You're going to go to hard money, then you're going to have investors and they're going to do a second on it. So it's just going to be a pure note, or are they going to participate with you? At that point, you are ultimately going to need an agreement between the investors and you. The hard money lenders pretty easily, because they want a note and a deed of trust, and they want it on first position, and that's a no-brainer, right? It's how you gather the other investments to your deal, and how do you document it. If they're a pool of investors, and it's going to be a note, you can do several people on one single note, or a series of notes, but that's trickier if you have more than one party as a second. You have to pool the investors on one secondary note. Otherwise, they'd be in second, third, fourth, fifth position, and nobody wants that, right? So you can do it as a straight note, or if you're going to have them participate, then you do need to have a contract with them that is this participation agreement. And you may want to form an LLC to buy it, and then they can be members. They can They can be members that don't have voting power. I mean, so that is the point. You have to decide, is it going to be purely debt, or is it going to be they're going to have an equity position, and then what is your deal with them? And at some point, yeah, you do have to go. You go online or you go to an attorney. You think through that contract, and yeah.
Yeah. Well, look, when you're starting out, if you don't want to spend thousands of dollars on an attorney, you're going to gamble, right? And that's the reality. Is you're going to gamble on someone that you either meet and you get along with, and you try to see, try to vet the person as best as you can. But the reality is, if it's a smaller deal, that hey, it looks like we're going to make $30,000, you're not going to want to spend $10,000 on the right contract, right? You're going to sit there and read it and make sure it makes sense, and there may or may not be some legal stuff that you may or may not understand, and you're going to gamble on that first deal and see how it goes. And that's kind of, if you don't have a lot of skin in the game and it's more sweat equity, that might be easier to swallow than if you're also putting in a bunch of money into the deal. Right.
First two, if you're stuck on a single family home, it's probably better to just use debt initially, and then if you have a second position, try to use debt if you can on that because it's simple and clean. If you can't, you have to bring a joint venture partner in. Get an attorney to write you a joint venture contract, for that second position. Just to have that in place. You don't have any legal liability protection with a joint venture contract, but at the same time, it's also for one flip, it might not be prudent depending on how much profit's involved to open an LLC, depending on how much you're trying to protect of your own assets, and there's a million different factors to determine if you should just get insurance for that deal or put it into an entity, or how much profit's on that deal, how big it is, how much of a second you have to bring in or how much equity you have to bring in. If you have to bring in multiple other investors involved, then you're going to be opening an entity probably for sure, but then you have to deal with securities issues and things like that. So sometimes on the securities issues, when you're pooling investor money together, in order for it not to be a syndication, you need to make sure that they have some control or ability to decision make, and that they actually do make those decisions too, because if they don't, then they could construe that they were passive the whole time. And so some of these types of things need to be outlined and understood before you go and start pooling money together for deals on bigger deals. But
I'd even say some of these things you need to get before you even go find the deal, right? So if that kind of structure is way too complicated, then you need to find smaller, simpler deals. I'd also say, and I'll get back here, is that when you're dealing with that type of situation, especially when you're dealing with another investor per se, that's a great opportunity to find someone who's got more experience than you, because they may have legal docs they've used in the past. At least you've got a starting point, right? Versus trying to find something online and starting from scratch. Yep.
Thank you all for sharing all. I was just wondering, when we do something like when somebody who's not like a template of an agreement or concept somewhere online, or
you're talking about sample legal docs on different kinds of structures like this?
Yeah, I've looked just online. When you just Google, you'll see all kinds of different ones that you can read through, and it's great reading right before bed. So just her question first was: is there a place that she could find, templates for legal docs? First Tuesday, I think, has a lot of them, right? FirstTuesday.com. They have a lot of LegalZoom has a bunch of samples. Nolo, yeah, Nolo.
Tell me about someone who's got some.
Westlaw.
I can talk about
that. Joint venture agreement, equity participation, shared appreciation loans, that type of that really. So shared appreciation loan is essentially a loan that has what she said was a pref. A pref is essentially an interest rate that investor is. I hesitate to use the word guarantee, but is supposed to be getting, right? Plus an appreciation or a share of the equity or profit. So shared appreciation loan, they're very common in the commercial world, and they're very easy to adapt into the residential world. That's probably the best term to search if you're going to search for some shared appreciation. You got it.
When you're primarily looking specifically for you're reading the provisions to understand the provisions in a little bit more detail, so you kind of understand what the major provisions are in these agreements, but they're not going to be a replacement for proper legal documents like in a specific state or something like that. You need to get an attorney involved in something like that.
Now, if you want to save a bunch of money when you go to an attorney, cut and paste here, have a document ready, send it over to them. That way, they're not putting it all together.
Because attorneys love it when you pull together a bunch of copies
They really do.
from different legal documents.
Okay.
Duct tape, super glue.
I have a comment on this. Yeah. I see some, it's like, this was from this site and that one was from that site.
Sure.
And none of it makes any sense. That's why I said in the very beginning, forget all that for a minute. If you're going to go see an attorney, save yourself some money and help your attorney by just thinking logically through the deal and literally typing it in a bullet point or 1, 2, 3 steps, how you plan to do this deal, how you plan to acquire, who's going to invest. It's really the best way to do it. It's just to think through. A classic, here, Law 101 here is a common agreement is first paragraph is the parties. And then you have what are called recitals. Here's what we plan to do. We are going to buy a property at 123 Easy Street. 2, we are going to redevelop the property. We are going to add a master bedroom on the property, or we're just going to refinish it and paint it. Okay? We expect that it's going to cost this much money. We are going to acquire the property for this. We will have investors. This is what our projected timeline is. And you just boom, boom, boom. These are all the facts that lead up to putting this deal together. And then how you get people out, which is usually the close of escrow, who has a responsibility and ability to hire the broker, who has decision making on that, and just lay that all out. That way, if you go see an attorney, for these deals, you've already thought it through, and it's really fascinating the difference between you telling somebody what you're going to do and then writing it down is night and day. And it's really so helpful to me if I can see the thought flow, so then I can catch it and it's like, okay, I got a little problem here before you ask me to review a document that's garbage, because then I'll spend your money reviewing garbage as opposed to you just writing out what your deal points are, speaking of a napkin. And I did want to point out, David and I were talking about this the other day, when your deals, you do a few of these and things, you do a syndication. I think this is fascinating. Now, as an attorney, when LegalZoom came out, I was a corporate attorney at the time, and I was charging in 1998, I was charging $2,500 to $3,000 for a simple incorporation because we did them, right? And then LegalZoom came out, and you can get them online for $300, right? So that marketplace went away. Didn't take my job away because people always do them wrong, but there's a very interesting program now. It's a woman who's worked for like Realty Mogul and some others, and her website is called Bootstrap Legal.
Amy.
Yes,
Amy
you know Amy?
I know Amy, yeah.
Oh my gosh, she's great. And so what she's done is she's applied that same kind of theory in that she sees many smaller investors doing deals without the proper documentation. So what she has these packages, and she has this, because of technology, this is now so doable because she has this entire matrix of questions. If, A goes to C, and then, if it's B, it goes down here and it cascades. So she can do a syndication agreement for you, and like they're $5,000 to $8,000, and you get a couple hours of legal, attorney review along with the document. Now, for many of you, based on what you're saying, you're not there yet, but keep it in the back of your mind and does it take away some business for some securities attorneys? Maybe. But it also provides an avenue for people who couldn't afford a $20,000 to $30,000 syndication fee to actually prepare some appropriate documents. I think it's phenomenal.
I think our first fund was almost $100,000 to put together before we could go out and raise $1. to give you an idea of how much it can cost. I will say one other thing, but probably the best advice I was ever given was early on in my career. And my mentor at the time said, he goes, listen, I want you to just look at every transaction as when you're sitting in front of a jury, how they're going to look at it. And he said, the further away it is from the norm of a transaction, the guiltier you look. Right? So if you have a hard time explaining it somewhere and something goes wrong, yeah, you look pretty bad.
Jeff.
Robert, what's the most creative apartment deal you've ever done?
So the question was, what's the most creative apartment deal I've ever done? Creative. That's a great question. So we bought a property in Long Beach. It was 16 units. And this is, the price is, God, this is going to age my, we paid $225,000 for a 16 unit, all 2-bedroom, 3-story elevator building. 1950? No, it was 1994. And the creative part was we had the seller, this is at the time where there were no short sales. So the creative part was he had more debt on the property than what we were paying and was in danger of losing it. Didn't want to lose it because he was a higher net worth guy, but the building was completely vacant and had to essentially orchestrate a reduction of the value and then getting the bank to move over some of the debt to one of his other performing assets, which was, at the time when they didn't have departments, getting to just the right person, and hearing, quite literally probably 50 people say, he just has to make the payments, and finally getting to the right spot to get it put together. And at the time being 4 years old or something like that, 23 years old, and having no money to actually go and put this deal together, finding then the investor to do, which, actually came pretty easily. Putting it together and then figuring out that I hated managing an apartment building and I bought myself a job, which sucked, right? Because you didn't want to do that. And I thought, wow, this is great. So we figured out that we could flip apartment buildings, but the creative part was just actually getting to the closing on buying it and not so much the structure of the deal itself. The structure was we found one single investor that came in and bought the property with us. We actually created an LLC with them, and it was kind of a pseudo partnership, and we probably did it incorrectly. But it was a friend of the family who said, yeah, that sounds great. $225, we're going to get how much income off of it? I don't know. I think we're going to get, $9,000 a month off of this building. But we were paying $225, right? Which sounds like a great deal at the time. I was passing on deals that were 3 times gross. I was like, oh, that's too much. We'll pay 2.5 times gross. Which means that 2.5 times of the annualized income is what my offer price would be. And so people now pay 12 times gross. Yeah.
Karen, I got a question for you. You mentioned before about the idea of I have 2 pools of money. One is in my IRA, one's in my bank account. Which one should I use? But a lot of times people want to use both of them. Can you talk about prohibited transaction and self-dealing a little bit?
That's why I love David. Okay. Don't do that. Okay, can you invest with yourself in your IRA? All right. Don't do it. But the Department of Labor has a ruling. Because like you said, you got to sit in front of an IRS auditor and explain how you had no personal benefit from that deal. Well, if it's you and your IRA money, of course you benefited because you made money. You benefited. So how do you prove you didn't benefit? But they did come up with a ruling, DOL 2000, because the year 2000-10. Okay, that's the ruling, where they say something to the effect of, if you already have all the money, plenty of money personally in your IRA, and you just decide to invest together, you decide to commingle or commingle, yeah, those funds, that it's cool, yeah. And that's what 2000-10 says. But I wouldn't touch it with a 10-foot pole, because I could never prove to the IRS that I didn't get personal benefit. And personal benefit is one of the prohibited transactions. Real quick on prohibited transactions, no personal benefit, so you don't loan money to yourself. And by the way, disallowed people, lineal ascendants and descendants. Anybody Catholic? You'll get this. Okay, so you can't, no ascendants and descendants, but the people out to the sides are okay, all right? So no parents, grandparents, you and your spouse, children, grandchildren, you don't invest with them. They're disallowed people, but brothers and sisters, aunts and uncles, cousins, they're okay, all right? So disallowed people. So can your IRA make a note to your son? No, he's a disallowed person. Can your IRA buy a house and then your daughter lives there? No, she's a disallowed person. Prohibited transaction. Prohibited transaction means game over for your IRA. And so that's really important. So your IRA doesn't do business. But I think with prohibited transactions, really where we see it the most is this little phrase that says that you can't provide goods, services, or facilities to the plan. And how legal does that sound? It sounds like a lawyer totally wrote that, right? Because it's in the Internal Revenue Code. If you're like a rule book kind of person, you want to write it down, it's IRC for Internal Revenue Code 4975, where you find these rules. But basically, so you're a lawyer, and your IRA is going to invest in a deal. Is it okay if you get a legal fee for doing the documents? No, because it's self-dealing, and also you're offering services to the plan. Even if you did it for free, you're offering services to the plan. So with real estate, we had somebody buying a piece of property here in California, and so their name is, we'll just say Smith, right? So it's all vested correctly, it looks all beautiful, we're going through it, and the card document, what happened? It's like an encyclopedia, so we're at the last page.
Attorneys happened.
Oh, okay, well, we love attorneys too. But at the bottom, you can see who's the broker of record, like who's the selling agent, right? It's the guy's dad. The last name's the same. So we have to get him to write us an email and explain who this person is with the same last name to know that they're not disallowed people. He says, oh, that's my dad. So not only did he want to be the broker of record on the deal, which is offering services to the plan, he wanted a commission. So it's 2 prohibited transactions right there. So that's another reason why you call us before you do a deal. We're going to ask you all these things, and we're going to take a look at your docs before it funds. Whether or not it's a prohibited transaction is 100% on your shoulders. But what are we here for? We're going to look at it. We're going to look at it. And if we see something, we're going to tell you.
Bill, go ahead.
Can you take a mortgage in the IRA down payment money?
That's like the most frequently asked question. So I'll repeat it so that everybody else knows what it is. Can an IRA take on a mortgage? And the answer is yes, but it's not the kind of mortgage you'd think. It's not like the kind we just go personally to go buy a property of any kind. It's not a Freddie, Fannie, FHA, VA, conventional, conforming, none of that. It is what's called a non-recourse loan. Now, non-recourse has a lot of meanings, right? But in this case, what this means is it's not a loan to you. So it's not a loan. It doesn't matter your FICO score. It doesn't matter how much income you earn. It's because it's not a loan to you. It's a loan to the IRA and for the property. So the underwriter's going to look at this property and what's the cash flow on this property. That's almost like 98% of what they're underwriting. The cash, is it a good deal? Yeah. And so they're going to look at location and condition like a normal underwriter, but what's the cash flow? So if the IRA defaults on the loan, then they can only come against the subject property, not against you as a person, not against any other assets in your IRA. And so that's how an IRA can take on money. Now, when an IRA does that, back to the tax thing. This is UDFI, Unrelated Debt Financed Income Tax. If you want a rule book again, if you want to read about it, it's IRS, their website, irs.gov. Look up publication 598. It'll talk about these twin taxes. Talk to your tax person. But so your IRA borrows money. Well, say, for example, you buy a house. I don't know, where can you buy a house for $100,000? Like Sacramento, maybe? Maybe?
San Bernardino.
San Bernardino, okay. All right. San Bernardino.
No offense.
All right. Ohio. Okay.
There we go, Ohio.
But your IRA buys a house for $100,000. So your IRA's got not quite enough money. So you borrow. So you put $70,000 of your IRA money, borrow $30,000 of non-recourse money. Well, here comes this rent check. It's $1,000. Well, your IRA earned $700 of that because of savings. Now, understand that the debt, it's almost like a contribution in a way because it's adding money to your IRA. So you're paying this tax on money that your IRA didn't save. So it's called Unrelated Debt Financed Income Tax, and your IRA will pay at the trust rate of 38% or 38%. It's a lot. It's a lot. But it doesn't mean it's a deal killer again because you can take deductions. So remember Stephen Covey? 7 Habits of Highly Effective People. Remember that? Begin with the end in mind. So just pencil. I know you're doing it already, but I know you're doing it already, Mr. Spreadsheet, right? But you pencil out your deal. Acquisition costs, closing costs, rehab costs, what else? Property tax, everything. And also factor in this tax prep fees. And what's your bottom line? It could be the best deal you ever did by borrowing money with your IRA. It's not a deal killer, but just take a look and pencil it out.
Here than here.
If you have a self-directed 401k, you don't pay that tax.
Yes, if your solo 401k does not owe the UDFI tax, it still would owe UBIT for investing in a business, but it doesn't owe UDFI tax for borrowing money. So.
Yeah.
Sounds very complicated. The IRA. And my question is, what are, it's a very high level of my question, but what are some of the watch out that disadvantages or vital numbers
Yeah. Okay, so she's saying that it sounds complicated to use your IRA to invest in real estate, and what are the, why wouldn't you do it? Well, it's fun, when we're talking to talk about all the blood and gory stories, because they're fun to talk about. But we I'm like, yeah, we're the news. But what we do, like hundreds of transactions every week, or people buying different kinds of real estate. So people do this. Our industry, again, it just came back from Washington. We discovered that our industry is sitting on at least $100 billion in assets. So, nothing to sneeze at. Probably more. Of all. No, that's not. So she's saying if only 3% invest in real estate using retirement funds, is it because it's complicated? No, it's because they don't know they can. It's because, for example, you watch the Super Bowl, and you see the Shankopotamus ad, right? But you see right from the broker dealer, or you see some, some other broker dealer is going to have an ad and they can pay for it. How are they paying for that? Where do they make money? Self-directed IRAs, we're not making money on your deal, so we're not advertising. Even as an industry, we're looking at doing national advertising on a national level. It's so expensive and we're not like participating in the profit of your deal, so we're not, because we don't advertise like they do. Why people won't invest in real estate with a self-directed IRA? A list of things. One, they don't really understand real estate. That could be, and they say, hey, real estate isn't my thing. I don't really understand it. I'm not going to do it. Number two, the attitude of, I don't know where we got this attitude, but it's just you deal with it. I don't even want to look at it. You just deal with my money. Well, that's what people said to Bernie Madoff, and that's what he did. He made off with all their money, right? So because people don't want to take responsibility for themselves, I mean, it's just human. We're human beings, and that's a human thing. So there's that.
Hey, Karen, if I can add too, because she asked, what are some of the biggest hurdles? I think when she was talking about self-dealing and dealing with your friends and family.
The prohibited transaction.
The prohibited transaction is probably the biggest hurdle. If you stay away from dealing with yourself or dealing with your immediate family members, and we've been talking a lot about debt versus equity here, if your IRA is dealing in debt, and it's a far simpler. If you're just lending money out of your IRA to someone else and getting paid back, that's a very clean, simple transaction.
Trust deeds are really big.
If you're trying to borrow money and
we talked about all the complicated things that
So
that's helpful. Right now, I feel like, wow, I don't think I want to do that. It's not complicated, but it's not that complicated.
The simplest way is exactly what David said.
Well, let's talk about the simple stuff then. Let's go simple for a second, because it's fun to.
It's a deed of trust. There's a lot of investors that, like, if he buys something, I might put my IRA with him, and he'd put his with me, and then there's no self-dealing there. But you could do that with anyone, right? It could just be a lender to someone else, and then it's simple paperwork. It's just a deed of trust. You're a note holder. That's your investment. That's it.
Your IRA could lend money to somebody even to buy a car, and then they make their car payment back to your IRA, like a friend kind of a loan. You can even do that.
It's as simple as, for investing, you're basically you open the account, There's usually what, a $270 a year fee.
$275, yeah.
So it's not that expensive. And then you fill out what's called a bi-direction letter, and you submit that with the paperwork saying, hey, custodian, please fund this investment. Here's all the paperwork. Within 24 hours, they're like, yep, here you go. Wired it to the closing or wherever you need it. And that's usually the case with a good custodian. Some of the custodians can be, take a little bit more time or be disorganized. But other than that, it's pretty simple. So actually making it, the biggest challenge is, did you do the due diligence on that deal in the first place?
Think of your IRA as the lender, right? And not as, because you can buy properties in your IRA, but that becomes more complicated than the simple transaction of just being a lender.
We had a question back here, and I'll come to Barbara in a sec.
Yeah, we don't do that.
So is there a way,
Well, so I'll tell you, the way I would look at it, okay, so the question was, with the short-term rental market, is there a way to borrow money against the income of a short-term rental? Is that? Yep. Okay, so I'll tell you the way I've always looked at short-term rentals. There's the value of the real estate, right, and what the income would be as a long-term rental and a normal market, and then there's the business, which is the short-term rental, right, and that business, which is more labor-intensive, creates that extra value. And so I bifurcate the two instead of looking at it as one, because if I foreclosed on your property, I'm not going to run the short-term rental. I'm only going to be able to rent it out for what the market would pay as a long-term rental. And so your business is hospitality, right? And then your other business is the rental. And so I look at just the value of the rental itself and not the upside of the hospitality, because that's not the business I'm going to run. Now, there are probably lenders out there that would look at giving you some sort of upside if you've got a long enough track record and a big enough portfolio that would say, okay, this is the business. And if, something happens to Joseph, then he has a business in place that it keeps going. And then there's more security in that. But to say that a small lender or an investor would do it, I would look at it two different ways.
Yeah, I think there are lenders out there right now that will loan you the funds or a percentage of the funds on your, initial setup costs and things like that for short-term rentals, even if you don't own the property, even if you're subleasing or something like that. But it's a very low collateral. It's hard to resell that collateral, so the rates are ridiculously high. The payback terms are high, because there is no collateral involved or real collateral, and they're betting on you as an operator. They're still underwriting the cash flow of the deal, but they're betting on you as the operator to do that aspect. So, a question in the back this time, and then I'll come to Barbara real quick.
When you're 15, he's saying once you turn 59 and a half, are there any restrictions? When you're self-directed IRA, your IRA is investing, right? So when you're 59 and a half, that's when you hit the mark that you can take, like in a pre-tax account, like a traditional or a SEP or a simple IRA, where you can take the money out without a penalty. In a Roth, you can take the money out, assuming you've had the Roth 5 years, you can take the money out tax-free once you hit that magic 59 and a half number. So that's cool. But I think what you're thinking of is the 70 and a half number, where you have required minimum distributions and you have to take the money out. And yes, there are restrictions there. So when you turn 70 and a half, you can't contribute to a traditional IRA anymore. You can only contribute to a Roth if you have a job. Okay, that's one thing. If your IRA owns a house and you're 70 and a half, you can't contribute anymore. And you have to take RMDs. And, you don't want to, we're talking about, we're going in the weeds, but you're asking me the question, so I'm going to answer it. Okay. So you're 70 and a half, your IRA owns a house. Every year you've got to take an RMD. And so hopefully you've got cash in that. So it's all of your IRAs combined. There's a factor. So you take the value of all your retirement accounts combined times that factor equals the amount of your required minimum distribution every year. So if you don't have that cash to take out and you have to use your hard assets, you might want to liquidate your property at that point, because what you have to do otherwise is every single year have the IRA pay for an appraisal and pay for a title company to retitle like a certain percentage into your own name as a distribution.
You can, but it has to go to your IRA first, and then you can withdraw it. So you can
never take personal use of your IRA funds. It goes back in the IRA first, and then goes to you. You can always, regardless of your age, you can always have your IRA money back. It's whether or not you pay taxes and penalties.
Yeah,
but there are those magic numbers of 59.5 when it's penalty free, and 70.5 when you have required minimum distributions.
Right, Barbara. You have a question?
No, I was just going to respond to her question about why don't Matt and I talk about this all the time. They don't teach financial education.
Oh, well said. Yeah.
Right? It all goes back to that. And so as adults, our kids that we have all just become lazy and said, oh, they know best. And so our retirement funds all went into mutual funds and stocks, and our IRA were the large corporations, but it was all done for us. And so we just sat back and said, oh, well, there it is. And that's going to take care of me when I retire.
Wow,
and we
it doesn't.
just gave up control. And so we have to start educating people, our friends, our family, our clients, to take back.
If you want to see a really good video about that, John Oliver, he's just so funny. Google John Oliver and look up teacup pigs, okay? And because there's this hysterical, Randy goes on talking really about what 401k companies are going to earn off of your savings. It's incredibly insightful, precise, brilliant, and he breaks it up with little stories about teacup pigs to make it interesting.
All right. Well, and I'll say keep coming to FIBI too, right? Like, I mean, you're all here. Oops, hang on. Big mess to clean up. That's the whole part of coming to FIBI is the fact that we are sharing information back and forth. So we appreciate you guys coming tonight. It's 9:00, so we're going to go ahead and wrap it up. Let me get a round of applause for our panelists tonight. Thank you guys.
Thank you very much.